We're back. Markets are opening up in 5 minutes, which means it's time for First Call. You're watching Tasty Live. I'm your host, Chris Vecchio in New York. He's your co-host, Ilya Spivak in San Francisco. Ilya, did you have a nice weekend?
It's been a great weekend.
What happened?
The weather was fantastic, and just being in the city was excellent. Took the ferry over to Treasure Island over here for a little food truck festival situation. It was great.
I got to attend a dance recital today for several hours. It was nice. My daughter danced for 3 minutes, and I got to sit there for an hour and a half, which was lovely.
That's how that works.
That's how that works. We got greeted by other news this week in Ilya. No, not another Mets loss. But another wave of news about Iran just before the market opens here. If you're following weekend oil, weekend Wall Street, if you're looking at hyperliquid, you may have noticed over the past hour or so that markets have taken a risk-on turn as we approach the futures market open. Josh, we can go right to the slides here and take a look at a market that closed on Friday at 7247.75. It looks like it may be 6 points higher or so in the early quotes that are coming in. Weekend Wall Street's up by about 0.4%, while weekend crude is down about 2.6% here. We did have that close at 102.50 on Friday, but it looks like the news over the weekend, at least in the past hour, that we could be looking for a way to break the Iranian side of the blockade is coming together. President Trump announced, Josh, I believe it's called Project Operation Freedom, something to that degree, something related to navigation of the seas. In any event, there's just been a lot of news. We're digesting it right now. We see that markets start taking this hopeful tone, as they have often done here, by the close on Monday, Ilya. So I suppose this will be something new. We're not going to have our gap open lower in stocks, our gap open higher in oil, although the markets did close lower on Friday. Volatility did come in after a big week. If it was the Fed meeting or the myriad earnings reports, Microsoft's, Alphabet, Meta, who else? Apple.
Big week.
Big week. And you know what? The earnings growth rate right now is just accelerating forward. We started the quarter in at 12.2%. The blended earnings growth rate after this past week of Mag 7 earnings was 27.1 for the first quarter, which is nosebleed territory, outrageously good. Ilya, I've said enough to set the stage here. Stocks look like they're going to open firmer, oil a little bit weaker. Do you care as a bear?
Not really. Not really. I think, and I've been talking about this right with you and elsewhere for a few weeks. Whether this current effort to de-escalate or the previous one or the next one, whether that goes through or doesn't, will determine how long of a disruption we will have, not if there will be a disruption. And the disruption's there. We heard from, among other things, all the major central banks last week, almost all of them. We heard from the Bank of Canada. We heard from the Fed, of course, the ECB, the BOE, the BOJ. The RBA is coming up shortly here. They're going to most likely issue their third rate hike of this year, because the conversation from all of these central banks is the inflation shock from the closure of Hormuz. That's there. It's not like we're going to resolve it with a peace deal. It's already arrived. Let's say there's a peace deal right now. It'll take months to actually implement. It'll take months for shippers to actually feel like they can send tankers back into the strait. Never mind leaving the strait. Leaving the strait, wonderful. There's a whole bunch of supply that's locked in there. Who's going to take an empty tanker back into the strait? And so this is, for me, and there's our upside gap as weekend.
Yeah, the opening prints are coming through. A little bit stronger than weekend Wall Street. 72.76 here at 0.25%. Nasdaq's up by 0.2%. So actually a little bit worse than weekend Wall Street, Ilya.
A little bit worse, yeah. But I mean, there's the upside gap. And I think reasonably so, right? The markets are looking at this. The president said over the weekend that the war has been, quote, terminated. That ostensibly means that he's not going to seek a war powers resolution for it in Congress because he's up against the clock there. So this now becomes a maritime enforcement action, whereby we get to come out and say, well, the plan was to degrade their ballistic missile launch capacity and their nuclear capacity. We've done that. We've bombed the bejesus out of all of those things. And we never said anything about the Strait of Hormuz. We never said anything about regime change. We said these were, things we would have liked to see, but hey, those were not the objectives. Our objectives were this. And because of this, we are now going to say that we're not going to seek war powers resolution. We're going to rename this thing, as producer Josh was telling us before we started. And we're going to rename it because it is no longer a military action. It is now a maritime enforcement action. Freedom of navigation is what we're after here. And what we're going to do is we're going to block the strait because Iran won't unblock it on their end. So you can go ahead and put that on almost permanent freeze as and until. Is that good news for oil, for inflation, and for rates? Of course not.
It's a soft open here for oil, 99.71. We're up down about 220, 230 or so as we ultimately make our way through this open here. Volatility is in a smidge. You see it here on the S&P 500 as well, where at the end of last week, we can go to the volatility futures, Ilya. We see a vol curve that is in contango still, but the front month, back month spread's a little bit narrower. Friday closed at 1976 here, gap open lower to 1930, which does put us right effectively back to the lows that we had on Friday. We've also digested a lot of the major event risk. There's a few things that are coming up this week. You alluded to some central bank meetings. There are a few earnings releases that we're going to want to talk about tomorrow. Palantir, for example, comes out. But, as we move through the other side of what is the most important week so far of the quarter, and then ultimately NVIDIA, I suppose, comes around the corner, what have we learned about the state of earnings in the world against this backdrop of war and what the Fed wants to do? The earnings growth is outrageously good. Is it so good that it's good enough to subsume everything else, given how far above the bar it is right now?
I think it depends which market you ask, because if you ask virtually any market not in the equity realm, the answer is what matters is rates and the war and what that means for growth and what kind of a disruption that will be, et cetera, et cetera. Obviously, I think if you look at equities, you get a different story. I don't think it's any kind of a coincidence that the moment that you get the war trade divergence, whereby equities decouple from everything else, is the moment on the eve of the beginning of the kind of meat of the earnings season. NVIDIA reported after the close on NVIDIA, excuse me, they haven't reported yet. Netflix reported after the close on the 16th.
Yes.
So the first market day then would be the 17th. Where's the bottom in everything? It's the 17th. Now, the dollar has pulled back maybe 50%. The bonds have pulled back maybe a third. Stocks have done the full round trip. Gold pulled back maybe 50%, or pulled up in this case. Stocks have done the full round trip and then some. So clearly, I think, there was a kind of desire in the stock market to pay attention to the earnings, or at least to not be skewed aggressively in a direction. Knowing that these earnings are coming, probably anticipating that they're going to be on the strong side. We've looked at, obviously, the numbers for traffic to the main AI tools, for the number of tokens used. OpenRouter provides those numbers. They're off the charts. The big four tech companies that reported last week gave us a combined nearly $750 billion in capex that they announced coming up to keep building data centers. It's not like the story isn't an obvious one. But the question, of course, then is, Is the story too obvious of one? We're at record highs. We got there on diminishing volumes. Who doesn't know that this is what it is? To what extent isn't this priced in?
Numbers are outrageous when we're seeing it in GDP. You pointed this out last week.
That's right. Outrageous.
And the way the numbers are calculated, a lot of economists are saying that it's even being undercounted, perhaps. Which is,
I mean, the first quarter, you just pointed out GDP. Just kind of hold this in your head for a second. A part of GDP that accounts for only 14% of the total contributed more to GDP in the first quarter than a part that is 68% of the total. And that is because non-residential investment, which is tiny relative to consumption, contributed more to GDP than consumption just because of this rapid build out of data centers. And so again, if it appears in data as stale as GDP is, which part of this hasn't been priced in yet?
You know, I can make the valuation argument, Ilya.
Sure.
We're still at a 26, 27.
It's a fair argument. It's a
when
fair
we were at 32
argument.
at a peak last year, and the Mag 7 names are not there yet. But just taking a quick look here at the opening prints, because we're just over 5 minutes into the session, we're holding near the highs as we gap open higher. 72.79 high, 72.67 low once the market opens here in ES, currently 72.70. NASDAQ is still very much in the leader position overall over the past few weeks. But today here, momentum is a little bit flat at the margin as we start through this open. And then, the Russell here too. It's actually the leaderboard at the top of the leaderboard at the start of this week, Ilya. And not for nothing, it put in a pretty good looking candlestick at the end of last week, where we got that bullish engulfing bar to close at a new high off of our 1 month moving average. It also feels like, I know there's concerns about energy prices, but could you make the case that in this new reshuffled world, domestic industry has a chance to be a pillar of a stock market rally as we here in America roll down the other side of globalization?
I think eventually, but it's very difficult to make that argument in an
Well, what about
environment
short
where the
term?
price of input, exactly. Prices of inputs are rising, interest rates are high.
Yeah, but we're talking about equity returns because globally last year, as we've discussed previously, right, emerging markets led the way. U.S. stocks were up, but if you invested basically anywhere else in the world, you did better. And you did better not just because of those stocks performing well, but because the dollar went down. So if you sold your dollars and bought euros and used those euros to buy the German DAX, you had a wonderful year, a much better year than the S&P 500, right?
Sure.
So given all of these real cascading effects, you kind of have this weird situation right now where the U.S. tech companies, which are the biggest part of the market, are giving us 27% earnings growth. And then you have all the emerging markets that are saddled with being net energy importers, right? So could you see a witness? Like, I'm trying to think, where's the relative gain right now?
In relative equity returns, I think you have an excellent argument.
Over the next 6 months, year.
I think you have an excellent argument. And that's actually an argument for risk aversion, if we sort of stop and think about it for a second, right? Because what does that mean? That would mean the flowing of capital to more liquid and safer markets within the equity universe, right? If we just forget that the other markets exist for a second, right? Put commodities aside, put rates aside, okay? Currencies. Let's just focus on equities. If what you're talking about is the flow of capital from non-USD equities into USD equities, that's a risk-off argument. Because it would be a move inward on the risk curve. Now, does that make sense in the current environment when the sensitivity to energy is greater outside the US, where the sensitivity to geopolitical risk because of a lack of ability to enforce one's geopolitical will, frankly, in the most realpolitik kind of way? Is that a reason to prefer US markets in this kind of an environment? Yeah, it is. In my mind, I think you have an excellent point there. Now, does that mean that equities as an asset class are going to go higher? Not necessarily. You could have US equities performing without necessarily having a broadly positive equity environment. That's a separate conversation.
Well, yeah, thinking about volatility here as we go into this next week, we do have this gap open lower. We have a VIX at the end of last week that closed with the 16 handle. So index vol remains relatively subdued relative to the perhaps density of catalysts coming up this week. It's not the same week as last week, but there are some earnings names that I think most people would be wanting to pay attention to. Palantir, of course, sure, is one of them. It's part of the AI story, of course. It's part of the war story, as its software, apparently Maven, as a platform, has been used with respect to some of the targeting in Iran.
Oh, yeah.
Of note, and it has government contracts in the works. We'll see what's going on here. 144. The last time we had earnings, Ilya, I recall a few months ago, we got that nice gap open higher in February, and then we immediately came back down to earth the next session. So the stock really hasn't made any progress since the last earnings report, but it's a 36.3 IVR, which is ultimately the point we're getting at here. Volatility a little bit higher than what you're seeing in the S&P 500. AMD on Tuesday after the bell. This is giving you a nice little volatility premium relative to the broader index. We talk about vol in the index being suppressed and it's a little bit more idiosyncratic risk right now. AMD with its earnings 82.9. It's at an all-time high. It's had just an absolutely tremendous run here, part of that semiconductor story, part of the chip story, as we continue to see those names just absolutely explode. You likewise have ARM Holdings on Wednesday. This has a 73.9 IVR. And then you make your way into the back half of the week, and it does kind of quiet down in terms of the tech related to AI and semis. Monday, Tuesday, Wednesday, you each get one. McDonald's, Gilead, they're not nothing, but I don't think folks are going to be paying as much attention to like a Brookfield Asset Management on Friday as they will to an ARM and AMD, a Palantir at the start of the week.
Sure. And in any case, toward the end of the week, you start getting into the meat of the important macro data, which of course culminates with NFP on Friday.
That gives us a nice bifurcation, by the way, where like it's really a micro focus. If you like, what should I trade? If you're an earnings person, you have the first half of the week. If you're a macro person, you're watching Iran, and then you have NFP on Friday.
Right. Exactly. And I think watching the volumes here is going to be really interesting, because the core of my skepticism in this run in markets has been stocks are off on an island by themselves. Their move is not being confirmed anywhere. And it's happening on increasingly shallow volume. So you look at it and you go, okay, well, this is starting to look like maybe it doesn't have conviction. Maybe this is more like an earnings season rebalance, because everybody knew the news was going to be good and didn't want to be stuck aggressively short. But now that you have this window, I mean, Palantir is, of course, a name to keep an eye on. So is ARM. But if you look at kind of the meat of what was going to be the good story, that was last week. And then we'll see what NVIDIA says, but that's 17 days from now. So there's maybe a window here where the markets go, right, so we gave earnings their due. Now let's get back to focusing on what everybody else has been looking at this entire time.
Go back to the question I asked earlier. I mean, I think, are the earnings good enough to subsume the other things?
Well, I think they already have. I think that's really the thing.
But in what environment are you giving up your equities if you go into the quarter expecting 12%? We get the whisper. I think, Josh, correct me if I'm wrong here. You told me that FactSet had a report a few weeks ago before earnings season started, and the whisper number for the actual result when all is said and done would be probably closer to 19%. Maybe that was part of the reason why the market was rebounding. Thank you. All right, it was 19%, and now it's up at 27. This is more than double.
But this is where the volume, I think, is the thing that bothers me the most. If this was optimism linked to earnings being good in a way that was novel, in a way that encouraged people to go, oh, great, something has happened that's new, you would be seeing building conviction. You would be seeing people laying out longer-term equity holding. That's not what this looks like because the volumes aren't there. And so if the volumes aren't there, you go, well, what is this then? Is this just people saying, oh, no, I was on the wrong side of the war. Oh, earnings are coming up. They're not going to be bad. We know what's going on in AI. We've seen the economic data. Okay. So stocks go off on their own because legitimately these numbers are excellent. But the question then becomes, well, so why aren't people buying these numbers in volume? Why are they not extrapolating this story forward? If they were, we would be seeing them do it. The volumes would be building on the way higher. But they're not. They're actually going down. The higher you go, the lower the volumes. So, okay, why is that? Is this just chasing? I guess we'll find out, but I'm not sold.
If it is chasing, right? I think about years past where we've had these environments going into the midway through the second quarter, especially last year, where a lot of folks were not on the right side in early April when the market began to rip.
Yes.
Can't this just be chase again?
It could be.
Is that
but I don't think we know that with confidence. And I think there is enough here to say, okay, Friday ended with a whimper. Momentum indicators are showing you negative divergence. Volume is showing you negative divergence. And now you're out of the big earnings window. Let's see. I think we're going to find out. And maybe it'll resolve higher. I don't know. But there is enough here for me not to buy it. I'm not selling anymore.
Fair enough.
I have the shorts I have. They've got a ton of time in them. They're at max loss. And so at this point, my incremental perspective is just, well, this capital is tied up. Worst case, it'll expire worthless at about 2% of equity. Okay. That's within the strategy's norms. But I'm not going to buy it.
Ilya, the past few weeks, we've seen some big names lead the way to the upside. Mag 7 have been doing a lot of the heavy lifting here. Mag 7 ETF trying to crack on that relative downtrend it's been in going back to late October, which NASDAQ holding up at all-time highs without the Mag 7 putting in a relative new high does speak volumes, in my view. The rally has brought
NASDAQ certainly looks a lot more convinced of itself.
And yeah, I mean, that looks like a hell of a false breakout, inverse head and shoulders. We achieve it. We move through the highs. We just keep building. When you see something bearish like this occur, that evening star cluster, and then you immediately break through the high within a day or two, you know that the momentum's so strong. Even the bears aren't able to get anything sticking together right now in the short term. So whether or not that continues is another story. I think it's going to continue to push higher here. I can't foresee this week's catalyst, the earnings this week, being so instrumental as to derail the rally. Particularly,
I agree with that.
Chip maker AMD and ARM coming up, which, given how the rest of the space has performed, why would we think they're not going to do well? But how much has been priced in? There's a difference between the market already having gotten there because it sees the tea leaves about what everyone else is doing and decides to buy AMD ahead of the earnings, versus this becoming a new catalyst for the next leg higher. But we move beyond the earnings here in the first half of this week and what's happening at the index level. Notes, rates, it's all tied to what's happening in oil right now. So if you're trading these products, stocks may be in their own la la land, but the dollar and gold and everything else has been very sensitive to the supply chain shutdowns, including some of the soft ag recently, which aided by some bad reporting on the crop yields. Wheat had a bit of a week last week where it was able to rally up some, although it gave back about half the gains as we came into the weekend. I saw a great tweet from Stacy Stuchart, which for those people that are on Twitter, I'm sure you know her as Shy Girl. Shy Girl, I guess. Kai Girl? I actually don't know how to pronounce that. Correct me. Hormuz is being modeled by a consensus as an oil shock, yada, yada. The consequential transmission is the slow repricing of chemical metal specialty input layer that sits beneath every physical product on Earth. Each cascade has its own time signature: oil days, fertilizer weeks, specialty chemicals months, capital goods and consumer durables in quarters, sovereign wealth flows, and reissuance capital, reinsurance capital in years. I think that is the story here. That we're only at the tip of whatever may be occurring, and stocks, if urea goes up by 40%, maybe that takes down S&P 500 profit margins by 1.5%, but they just went to 27%. So shave off 1.5 of that. Are we still above expectations where we thought we were? Hell yeah. We're way above.
Maybe.
I think the point I'm getting at here, Ilya, is if oil, we do see an end to the war or a break of the blockade or a peace deal, a ceasefire, something that happens, right? Oil is going to probably take it on the chin the first time. A lot of things will come back in, but it doesn't mean that it's over.
Not by a long shot.
And likewise, if something's going to hold up throughout all of it, stocks have pretty much made their name clear. We are willing to look past the Iran war because there's so much money being made
now.
Elsewhere.
That has certainly been the case, and this to me is the critical part of the question. If we went up on diminishing volume into these earnings, knowing that these earnings are going to be stellar, because I don't think anybody had any reason to doubt them, and lo and behold, there they are. I mean, it's not as though the individual names uniformly rallied, though all of them beat. All of them. And on every metric. So there was diversity there, but clearly the market looked and said, okay, we're going into earnings season. Great. This is not going to be bad news. You do not want to be super, super short when you know there is a batch of good news coming, right? So the market corrects. It picks up volume and momentum because that correction clearly has picked up all kinds of interest, in particular retail interest. But this is happening without significant volume. Okay. What happens when the earnings end? Maybe it's self-sustaining. Maybe it's enough momentum to kickstart things. We took out the October high. That's meaningful. Maybe that sucks in momentum, but so far it hasn't.
That's a really good point, and it's an important texture of this. About the momentum not being sucked in. So on one hand, retail activity as a percent of volume in the stock market has rebounded from its lows.
Yes.
Single stock activity has bounced back, but it's not back to its levels where it was at the end of last year, the beginning of this, where it's like 14% market wide as single stock trading volume. Throughout the war, it got back to the post-COVID post-COVID average since the start of 2020, about 8% of a single stock trading volume in terms of total market activity. What we've seen is a bounce back, right? It's definitely coming back. The volumes are there, but it's more heavily concentrated in index products from the publicly available data that we've seen from Citadel, from JP Morgan, from what's available on Bloomberg here. You're looking at, I would say, intensity is there. Retail attention is certainly there, but it's not moving back and getting out of ES and triple Qs and the associated index level products. So on one hand, I hear you about retail not joining in right now. They've been very selective about dipping their toes back in. They've been taking the shots where, we look at leaderboards of Wall Street Bets is a good example. The only time you're seeing single stock names rise up into the top 10 is when they have earnings. And when the earnings come off the calendar, they're falling right back. So it's a very selective, event risk driven. But the point that I'm getting to is that also could mean that folks are waiting for like the Iran war to end to start the relentless buying again. Because if you're a retail trader doing zero DTEs, which the last time I saw OCC data, 29% of total market volume were zero DTEs in SPY, right? If you're going to be that kind of person, you go, you know what? I don't want to do that as long as we have this sort of Damocles over ahead of a tweet, a Truth Social post, whatever the propaganda continues from either side, that could totally screw up my zero DTE trading plan. So until the war ends, I'm just not going to do that kind of stuff. And so maybe we're waiting for the volume to come back in once we get the all clear. So I don't want to dismiss that too, because what happens like low volume 10 years ago, Ilya, it was a different type of market 10 years ago. Zero DTEs didn't dominate the volume profile. Whereas today, that is the case. And how can you trade zero DTEs if 1 minute you could be looking at a trade where you're at like a 90 delta and then Trump tweets something and now you're trading at a 5 delta and this thing is completely underwater. So I'm trying to be open-minded about this. I know that I'm not saying that you're not, but I think the change in the market structure requires a deeper examination of how retail volumes may or may not be participating.
No, so to me, retail volumes participating is a big part of this story, but they are participating seemingly without the larger pools of money participating, and that's why the entire melt higher seems to be happening with diminishing volumes overall. So there does, I think you're right. I think participation from retail, especially off the bottom, especially considering retail's, let us say, propensity to prefer the long side and think every dip is a buy, I think that participation is there. And you're right. It's centered on the indexes and it's centered on the short term. First of all, that's risk off behavior relative to longer term exposure in individual names. So confidence, this does not scream. But I think clearly retail is here. The problem is that retail is not what's going to take this thing up another 20%. And so the question is, again,
Yes,
are you priced for the news?
Up 20%. Yeah, we're probably priced for the news. I mean, you got a VIX at 16.99 on Friday's close. I mean, how there's that complacency here at the index level again. But we also get back to environment too, and I think this is an important point. February, it's a 99th percentile dispersion environment. The movement in the S&P 500 relative to the movement in the median S&P 500 stock on any given day over the past trailing 7 days, trailing 30 days, it was a dispersion environment. Indexes weren't doing anything. All the action was beneath the surface.
Well, something to keep in mind here also is that when you look at the spread between hedger and speculative positioning, we just got the COT index update for the S&P. The net short exposure there has been diminishing for the past 3 weeks on the way up.
It's been diminishing. But has it been a big short covering rally? Not really. It's not like it flipped from very short to not short.
No, it flipped from being short. So it was actually basically flat at the beginning of April. And then really it was about the middle of April, again, right on the eve of earnings, that in COT report numbers, which are going to be odd numbers because it's data released on Friday as of the preceding Tuesday. It's a whole thing. But the week of the 14th in COT reporting,
which came before all the earnings too last week.
Right before all the earnings is where there is the big net short exposure. Since there, the previous 2 weeks, we've seen that exposure come in as we've moved higher.
Ilya, we're closing out shop here on First Call. 72.64 here on ES. It's been a pretty quiet open. We did get the gap open higher thanks to those remarks ultimately by President Trump talking about a potential deal with Iran and this Project Freedom to secure the navigation of the seas in the Strait and help get these ships that are trapped in there out. We did gap open higher to 72.79 at the high. We're back in at 72.64 here. The low after the open has been 72.62, so a little bit of a fade. Oil, which touched a low of 99.11, is now back to 101.28. We closed Friday at 102, 102.50. So oil is taking back more than half of its loss here. Maybe it's an inverse Monday, Ilya. Instead of the gap open, lower in stocks, higher in oil, and we get the reversals for the close on Monday. It's the other way around. But you know what? We're done here. We'll catch everyone tomorrow morning, 8 a.m. Eastern, 7 Central Time. I believe I'm on with Nick, perhaps. So see everyone bright and early tomorrow. Until then, though, good luck trading and keep an eye on the news tonight. It looks like we're going to have a night filled with headlines about Iran. So if you're trading oil, trading S&P 500 futures, don't step too far away. See you tomorrow.
know we